New official statistics out this morning show a stronger than expected jobs number in the U.S. and an official unemployment rate that's actually the best it's been in quite some time, down to 3.5% in September from expectations that it would remain at 3.7%. But what's good news for markets, for workers, though, is bad news for risk assets, as modern markets, long addicted to central bank intervention, typically these days view good economic news as bad news for traders. That's because if things really get bad, they reason, the U.S. central bank will reverse its course and return to the easy money policies that kept markets on the upswing, even as much of the global economy was shut down over the last few years. And that is, in fact, actually what we saw within just the last few weeks, as the Bank of England abruptly reversed a similar policy of so-called quantitative tightening before it had even really started it, essentially bailing out pension funds who found themselves near insolvency as their risk models failed thanks to changes out of the central bank. Zach, it feels like we've had this conversation before. Is this just our lives now at this point? Just reporting economic news and being like, this isn't bad enough. It's not bad enough for markets to turn around.
The road to boring.
It is pretty weird. It is pretty weird that the crypto world is so closely attuned to these macroeconomic pronouncements, right? This is the jobs report is as closely watched among, crypto Twitter as it is on FinTwit or whatever they call it over there. Or, I don't know, global macroeconomic Twitter, economist Twitter. But the idea that it really kind of brings into focus that the idea that crypto is this alternate world or this alternate reality is not really grounded in any fact. It's very much a part of the reality of this macroeconomic reality in which we find ourselves, be it crypto, be it tech stocks, be it other assets that saw a great run up when money was being printed fairly liberally. So the idea that Bitcoin has responded in turn to some pretty positive jobs numbers is not to be unexpected. We should be expecting that. We've seen that time and time again, that Bitcoin is trading more sophisticatedly and more linked to existing macroeconomic factors than it had been in the past. Right? You get more sophisticated traders, and they treat this asset like they would any other risky asset. And so you see some of this action on the price chart. I don't know if that's to be mourned or to be celebrated, or if it's something that we should, care about one way or the other. But it really is the reality of the crypto markets here in 2022, and even in 2021 and 2020, when it reached sort of a critical mass of being a thing that would be traded by sophisticated traders who are acting in response to policy pronouncements from major countries. So that's what I see here. I don't know beyond that. I don't know, but that's just sort of my gut about what this story might really be all about. But Jen, I'm sure you have something to add.
Yeah, Adam, I'm always so happy when you're on the show because I learned so much for you. So while I'm still trying to wrap my head around what these numbers mean, I want to bring a little tweet from Wendy O into the show because she's not here today. She did a survey on Twitter this morning asking her friends and followers, do you believe the job report data? And 68% said no. Tell me why people aren't believing this data, and who do we believe?
I love this question. So there's a couple of different things going on here. First off, just recently, again, over the last couple of months, we've seen significant revisions to this data, which is another way of saying that the initial data that we talk about on this show is typically wrong in hindsight. And we'll get significant revisions to really any sort of official numbers that come out, which tend to make them be very different than what we're talking about today. So these are numbers that are supposed to kind of guide our view of reality, and they do guide our view of reality. And so if they're wrong, and then we talk about them when they're wrong, and then they turn out to be different later, then that means that we've been misled about what reality is actually showing us. And that's really important because we make decisions based on what we think is going on in reality, right? So that's kind of one side of it, is just that these numbers aren't trustworthy. And they prove over and over again to be wrong. And the other thing is that all of the agencies that we're talking about here, they're all part of the government. And the government gets measured in terms of their effectiveness by how well they're doing by certain metrics that people judge them by. And these are numbers that they get judged by. So it won't surprise me at all if we find out after the election that actually these numbers were a lot worse than people thought. And had they come out, with the correct numbers, or what they say will be the correct numbers, at whatever point they revise them, that actually today would have been an up day for risk assets, but it would have been a down day for sort of the political status quo, because it would demonstrate that actually damage is being done here to the economy, which is what we know. It's also worth noting also that, again, markets right now are kind of obsessed with the idea that, well, we need the jobs market is the part of the industry that's strong, right? The part of the economy that's strong right now. And so it needs to come down in order for central banks to reverse what they're doing. Well, there's another argument here too, which is that central banks, when they do these hiking cycles, when they raise interest rates, especially aggressively as they're doing now, it takes a long time for that to make its way through the economy. So people are expecting, oh, hey, interest rates went up 0.75% last month, so that will have an impact on, sort of jobs this month. That's not typically how it happens. In something like 7 out of the 8 last hike cycles, that is what we're going through right now, going back to the 1970s, more than a year later, the jobs market was still tighter than people expected it to be, and was actually in a better situation because, again, these hard times force people into taking jobs that they might not otherwise take. And they kind of, it takes a long time for, this is not like a sailboat, right? We're not like spinning around, quickly because we want to make a turn. This is a cruise ship, right? Like it has momentum behind it. It needs to make very, very wide turns. And so that's another big concern right now, is that the Fed is using these very short-term metrics to determine whether they should or whether they shouldn't suddenly kind of change course. But a lot of the stuff that they're doing, we're not going to see materialize in the economy for probably another year. So it's a bad way to make these decisions. And again, this is from people who have a track record of not doing very well at this stuff at all. So there's not a lot of trust on my side either. And it's not a great situation. But anyways, Danny, let's go to you.
Yeah, I mean, maybe I'm just naive. I guess I don't have... I guess I'd like to believe that the Bureau of Labor Statistics is doing a best effort to get the real numbers out there, and that it's not a partisan endeavor. I don't know anything. I'm just a guy wearing a Charles Hoskinson jacket on internet TV. So you shouldn't listen to me on any of this stuff, to be quite honest. But I would say I would agree with Zach. Like, this is really just another sign of the evolution of the Bitcoin markets. Right, we are now in a place where Bitcoin, where we have traders who trade this risk asset based on macroeconomic environments. And it's not just, you could say, the quasi-religious crowd of hodlers anymore, and it hasn't been for years. So because of the participation, this broad macro participation, this is what Bitcoin reacts to, and it's neither good nor bad. It's just sort of a reality of a maturing investment market.